Introducing the Brown Advisory US Small Cap Blend Fund, which is a core US small cap strategy aiming to generate attractive risk-adjusted returns and outperform the broader Russell 2000 index. The fund aims to exploit inefficiencies in the US small cap space by blending Brown Advisory's US small cap growth and US small cap fundamental value strategies in a 50-50 portfolio allocation. The fund is co-managed by two portfolio managers, Chris Berrier and David Schuster, who bring over 40 years of combined small cap investing experience. Chris heads up the small cap growth portfolio, looking to exploit undiscovered early stage opportunities, while David leads on the value side, focused on underappreciated companies poised for positive change. Neither strategy is aggressive in its style, and the portfolio managers are supported by a sizable fundamental research team, tasked with identifying opportunities in this often under-researched space. The fund provides investors with broad exposure to the asset class while minimising style risk, thereby providing investors exposure to the best of the small cap universe across the value and growth spectrum. Brown Advisory has a long history of investing in US small caps, managing various strategies in this space since our inception in the late 90s. We believe a dedicated small cap mandate with a blend of growth and value companies enables investors to capitalise on the long-term performance potential found in the asset class. To start, can you introduce yourself and also the team that support the US small cap growth strategy?
Yeah, my name is Christopher Berrier. I've had the pleasure of managing the US small cap growth strategy for quite a long time, along with George Sakalaris and a broader team of analysts who cover all of the major sectors of the US economy. I would tell you first and foremost that when we talk about the strategy, the foundation of everything we do is the team. Without having the right people in the right seats, your chances of success are very, very low.
Maybe you could just give us a brief overview of the strategy itself.
What we are attempting to achieve is to drive higher returns with slightly less risk than the benchmark over a long period of time. Our goal is to try and drive 100, 200 bips per annum and do that over a full market cycle. So we are not attempting to divine what is the next great area of the economy that's going to work and put all our chips there. We're trying to find best of breed businesses in each area of the economy, have the strategy largely be diversified so that it can be something that is quote unquote all weather. You can buy it, own it as a part of your broader portfolio, and hopefully our solid bottom-up stock selection will allow us to achieve the returns that we want and we know our clients expect and deserve. That is one way for us to harness the power of compounding. It's a way to deliver better than average returns and do it in a manner whereby we have a high quality portfolio that will probably do reasonably well during periods of stress because of the types of businesses that we're owning. And therefore we can get that best of both worlds, which is hopefully above average returns with a little bit less risk.
And how do you really identify those companies and what is it that you're specifically looking for?
So when we start diving into the companies, we're really looking for three things, and we refer to it as the 3 Gs, mainly because it's simplistic. We're looking for durable growth, sound governance, and scalable go-to-market strategies. And I won't get into depth in each one of those, but in order for a business to go from being small to mid to large, you have to be able to grow at an above average rate for a long period of time. And that's why we're looking for durable growth. We want larger markets relative to the revenue base of a company that enables a runway to grow. And if that company is doing something differentiated, allowing it to take a larger slice of a growing pie over time, that even sweetens the pot and that enables the growth to be even more prolific than we originally thought. The second piece is sound governance. Now, obviously, what we're trying to achieve with the businesses we're invested in is essentially value maximization over the long term. Right? Not short-term compensation maximization, which can sometimes happen within the corporate businesses in the US. So we want a diverse board of directors with the requisite knowledge and experience to help guide the management teams. We want CEOs, CFOs, et cetera, that we think are capable, honest people and aligned with us. And we would hope that that alignment is what drives an outcome that is both acceptable to us, our shareholders, and them as a management team and a board. And the final one is go-to-market strategy. So this is something that's going to come up in every single analyst day that our companies have. And when we think about the businesses we're investing in them, Many of them are subscale. They're not quite large enough to be at their target business model. And so when we talk about scalable go-to-market strategies, what we're thinking about is really in terms of unit economics. If you sell one widget, what does a company look like? What about 10? What about 100? What about 1 million widgets? How profound is the change from sort of startup mode to being a much larger company? And what does that mean for the financial profile and what might people pay for it? So if we can find what we think is a large end market that a company can grow into, we like and trust the people, and we think that the unit economics can scale through time, those are the businesses that we want to invest in. No company is perfect, so you don't get a 10 out of a 10 in each of those, but you want to make sure that fundamentally a company has those ingredients, because when it does, it frankly just has a higher probability of making the journey from small to large cap than the rest of the field.
Hi, David.
Hi, John. How are you?
Good, how are you?
Good.
Thank you for joining us.
Thanks for having me.
So to start, why don't you introduce yourself and the team that supports the strategy?
Yeah, sure. So first off, my name is David Schuster. Been at Brown Advisory since 2008. I joined really to start the small cap value strategy. Been running and managing that strategy since then. So a long time, supported by a great team of analysts. The analysts are kind of across industries. I have a wide range of experience and expertise. And generally, as you would think of on a value strategy, tend to be the ones that are more skeptical, really valuation oriented.
So from there, why don't you briefly describe the strategy's investment philosophy?
Philosophy really has kind of three key tenets: free cash flow, capital allocation, and valuation. That was really what we laid out when we first thought about starting the strategy. The free cash flow really kind of came from an observation that we had that there's a tremendous amount of M&A activity in the small cap space. And so we really thought about what drives value in those transactions, what prompted people to actually do transactions, and ultimately it's free cash flow. The second piece would be capital allocation. Clearly, we're very concerned about what our management team and boards are doing with all this cash flow. We spend a lot of time with them as part of our due diligence process, and even after we've made our investment, making sure that they are really adhering to what we think is best-in-class capital allocation. And then finally would be valuation. Clearly, we're a value strategy focused, trying to find these opportunities that we think are really inexpensive valuations.
So with that background, briefly describe the investment process.
First off, it is a big universe of companies out there. Depending on the study that you look at, there's anywhere from 4,000 to 6,000 companies in the universe, depending on what you include and what you exclude. And so trying to sort of narrow that down is really, really important. Our process is a little bit different. We have sort of a recognition that there can be a lot of companies that might look quite expensive in a valuation screen, but in fact are quite inexpensive when you roll up your sleeves and do real fundamental work around the balance sheet and the valuation. We intentionally keep a very wide funnel at the front end, and the way we execute that is really just having a very aggressive outbound calling effort. Any given year, we're probably doing 250 to 300 calls, outbound calls, to small cap companies across the team. And really what we're trying to do is we're trying to figure out, okay, is this a company that we think is really worthwhile, has those three attributes that we're looking for to really continue during the due diligence process.
So from there, why don't we talk a little bit more about the differentiating characteristics of the investment approach?
Yeah, I think the first really sort of starts with philosophy. If you think about value managers, that could mean a lot of different things in the value space. There's a wide continuum, from very deep value all the way to sort of almost core-ish. Some people use the term, sort of higher quality, maybe as exhibited by return on equity or return on invested capital. Those would definitely be characteristics of the portfolio. But really, the philosophy is, I wouldn't say it's unique, but it's definitely differentiated within the value space in the sense that we're not looking at what might be other traditional value categories. So think of turnarounds, think of reversion to the mean, those types of situations. Certainly understand why those might be appealing. We just find that in the small cap space, there's enough opportunity out there that we really don't need to go there. We can basically pick our spots where we think we have a much more attractive risk-reward ratio.
What's the opportunity in US small caps?
There's a massive long-term opportunity and one that's been enduring. There's a couple thousand companies in the US to choose from. And the US is obviously a pretty vibrant economy historically. There's a lot of new business formation, not just out of Silicon Valley, but these days via technology all around the country. And that's our opportunity set, one that's 2,000 companies and growing. And our biggest challenge is not finding stuff to buy, it's narrowing down that list into a select few businesses that we're focused on, which are those that can grow from being small cap into mid cap companies, and if we're a little bit lucky, into larger cap businesses over time.
Maybe bringing it all together. Why invest in small cap value?
I really believe that they are a core asset class. You look over a long period of time, small caps have generated incredible returns. They tend to be in favor or out of favor for periods of time. But when they're in favor, the outperformance is quite significant relative to the broader market.
If you're willing to tolerate slightly higher highs and higher lows in the short run, chances are over an extended period of time, you're going to get compensated for it with higher returns. So we like to think of having small caps as a key part of your overall portfolio.